Hello, everyone. This is Philip Nelson. Joining me today is Jen Appel, and we're going to be spending the next 40 minutes or so walking through, our views on the market and current opportunities that we're seeing. Here's a couple minutes or a couple quick statement on just logistics. We'll take questions at the end, and there should be a question box on your screen within the WebEx for you to enter those questions. So please do so, and then we'll hit the questions at the end. So with that, I'm going to turn it over to Jen to kick us off.
Thanks, Phil. As we've done in previous quarters, we're going to start with just a broad overview of asset class performance. But just to set the stage up front, a lot of the market movements we saw this past quarter can be attributed to the impact of the trade war and a softer global backdrop. So you're likely going to hear that sentiment in many of the comments we make today. So with that in mind, we'll start by talking through the macro section with those red bars on the top of the screen. We had another quarter of declining global rates with significant demand for safe haven assets, given some of those factors I just mentioned. And as a result, the 10-year US figure fell 32 basis points. But this isn't something that's only impacted trade, but equities as well. And if we look to equity volatility as measured using the VIX or volatility index, it only increased 1.4 points over the quarter. But this doesn't really tell the whole story since we're looking at a very specific quarter over quarter time period. So for a bit of context, in August, the VIX was quite elevated compared to the low volatility numbers we've experienced for some time. So even though that absolute change was pretty small, the ride over the whole quarter was likely a little bit less smooth than those numbers may suggest. And if we expand this lens to look at a longer time horizon, we end up seeing a pretty different picture. Here we're showing quarter-to-date versus year-to-date returns. So looking to the blue bars on screen, the year-to-date basis, all major asset classes are positive, and performance has been pretty strong across the board. But the quarterly figures are a lot more mixed. On the equity side of things, to the left of that vertical dotted line, performance was pretty volatile, as we just mentioned with the VIX, but returns were varied. U.S. equities ended modestly higher, while international and emerging market returns were impacted by trade and weaker economic data, but dollar strength also played a role here as well. In contrast, most fixed income indices, including safe haven and lower quality credit, were positive, adding to already sizable year-to-date gains. And those outsized returns are just one aspect flowing into our view to reduce lower quality credit that Phil's going to touch on when we review our current opportunities. So with these sources of uncertainty, the economic outlook has deteriorated around the world. And you can see this clearly in looking at declining growth expectations. The IMF recently published their October World Economic Outlook, and they've revised nearly every major region and country's expectation for 2019 GDP downwards since the beginning of the year. So that's what's being shown on the left here, the difference between the October versus January estimates. And just a couple interesting points here. The top, the world growth rate is down 50 basis points, and it's now expected to be 3%, which marks the weakest projected growth rate since 2009. And in the developed world, the US is modestly lower as you think about some of the fiscal stimulus rolling off, while in Europe, they're battling some weaker demand and really this huge question mark around Brexit. Finally, in emerging markets, they received a pretty healthy haircut as well. The small reduction to China is probably not surprising given the softening growth trend we've seen, but there's also a lot of idiosyncratic risks happening in different countries like Russia, India, or Brazil. And India specifically had one of the largest declines year to date in expected growth, given weakening demand and the growing need for regulation cited as other reasons. So as I look to this, it appears the days of synchronized economic growth we saw in 2017 and early 2018 are behind us. And if anything, it feels kind of more like we're in a synchronized slowdown, or at least temporarily. But despite that somber picture you can paint using that left chart, 2020 projections paint a much rosier picture, meaning some of the transitory risks or negatives weighing on the outlook are expected to improve, especially in emerging markets. So with that background in mind, we're going to review some of the underlying data that's changed and impacted this more negative outlook for the year. One of the areas that's shown significant weakness is in global manufacturing. On screen, we're showing the number of economies out of the 20 largest with PMIs below 50, representing that they're in contractionary territory. Really, since late 2017, early 2018, when trade becomes a real headline risk, we can see that number gradually increases. And in July of this year, 16 out of 20 of those economies had readings below 50. We've come back in slightly from that high. We're now sitting at 12 out of 20 economies, but that's clearly still an elevated figure. And with trade risk seemingly not disappearing tomorrow, combining that with some of the other data that's come out around business sentiment and investment activity, there's not a strong case to be made that this is going to reverse, at least in the near term. So if we look specifically to the US economy, we haven't been immune from the weakness that's happened on a global scale. We've now been below that 50 level for over 2 months, and there's a lot of other hard data that you can also use to paint a pretty ugly picture for the state of the US economy. But that being said, there's this growing bifurcation in the economy between some of the economic activity-based data and what's been happening with consumption. Even with all that noise from trade contributing to a relatively weaker economic backdrop, the consumer has remained the bright spot in the economy. In aggregate, the consumer's balance sheet is still healthy. There's nothing really over-levered about it. Spending has been strong, and even confidence remains high. So looking to the bottom of the screen, we can see consumer confidence, though it's pulled back in recent months, we're still near dot-com levels. So even with some of the weakness that we've seen, readings at these levels are likely a good sign for continued support from the consumer, at least in the near term. Now, as I mentioned up front, a lot of what we've seen transpire so far this year has been an outcome of the US-China trade war. And we've already walked through some of the impact this has had on the data and market volatility. But on screen, we have a synopsis of what's panned out for the year. We've really tried to keep a timeline of what's gone on in between these countries in terms of tariffs and good restrictions so far. And at this point, a lot of the rhetoric we've seen is pretty similar to last year. But even with that phase one deal that was recently announced, we think that trade risk is likely here to stay, and that any further escalation in this relationship adds a large tail risk to capital markets in general. So look at this from a different lens. This chart shows the weighted average tariff rates across a variety of countries. On the left, with the lower tariff rates, are most developed economies, including those countries in the EU, Canada, and Australia. That blue bar to the left represents what the US average rate was in 2016. That other blue bar that we've called out represents the hypothetical average tariff rate for the US if they were to impose a 25% tariff across all Chinese goods and impose additional car tariffs. While this specific scenario hasn't transpired, we've already kind of started down this path. And even if that exact situation doesn't happen, we're clearly moving toward a higher average tariff rate. And in this example, the US shifts to having a higher rate than many more closed off emerging market and frontier economies like that of Argentina or Brazil. And this generally makes for a much less friendly environment for global trading partners. Given some of the uncertainty that I just mentioned, there has been this shift by global central banks in response to the current environment. This year alone, most central banks have lowered their rates, including notably the Fed and the ECB. This really just demonstrates that we're no longer in a tightening environment, but that there's more of an easing bias existing out there. And with some central banks pushing their policy rates into negative territory, along with the continued rally in government bonds, there's been this large year-over-year increase in negative yielding debt. We kind of view this as a helpful indicator to show that the bond market is pricing in some real concerns about the global economy, despite some of the optimism that we've continued to see in equity markets. And lastly, to finish up the market review portion, within real assets, oil had another volatile quarter. The attack in Saudi Arabia led to over a 15% daily increase, marking the largest single-day gain since 1988. So this is just some other evidence to show that global geopolitical tensions are seeping into capital markets as well. So with that, I'll turn it over to Phil.
Thanks, Jen. And just as a reminder, if you do have questions, please enter them in the Q&A box in the WebEx, and we'll get to them at the end. the slide you have here is not a foreshadowing of winter coming, but it's something we started to do the last couple of quarters, just to think about how active or how do we assess the state of our key market themes? So are they emerging? Are they fading? Are they at a more neutral level? And one of the things we've tried to do is use it as a communication tool to imply what are some things that we're seeing in the market environment and what's causing changes in market conditions. And we will look to our three key market themes. What we've done is look back the last quarter to see how some of the economic conditions have influenced these themes, and vice versa, how we think some of the themes are influencing markets. Not a lot of change here, but I think one thing that would like to mention as we think about our globalization backlash theme, which is one that's been very present for several years now. We bumped it up a notch to be a little bit more active. And some of that is, around some of the negotiations we're seeing between U.S. and China in terms of trade policy, which we're starting to see slightly more, optimistic statements coming out of both parties. I think more so is, some of the changes in posture between the U.S. and Europe, where we're starting to see an expansion of tariffs maybe beyond just a simple, U.S. versus China relationship. And should we be seeing a larger expansion of tariffs and disruption? And so that's primarily thinking behind that in terms of our thoughts on that front. And one of the things that we'll probably be spending more time talking about next year is just what's the dynamic, especially in an election year, between China and the U.S. In terms of kind of the transition for China and becoming a more emerging player in the world stage. And as I said, we have three key market themes that we're evaluating or constantly looking at today. I want to focus maybe on just one of them for a minute or two. And something that we've probably talked about ad nauseum for folks that have dialed in for the last few quarters. But just the fact that we really think we're in a late cycle market environment. And I think the refrain that we've been constantly stating is, late cycle doesn't mean end of cycle. You can still see, quite a bit of kind of, positive outcomes coming from the capital markets in this type of market environment, as we've seen this year with equities being, so positive. And I think that's the one piece that we'd like to emphasize, especially when we think, what has the Fed done, in the last quarter in terms of, easing rates, or as they, called it a mid-cycle adjustment in some ways. It really supports the view that, this late cycle can really continue to expand. And it can last for quite a long period. And so the expansion that we've had post 2008, 2009 financial crisis has been pretty prolonged. And that's one that if you have a prolonged expansion cycle, lends credence to the view that you could also have a prolonged late cycle as well. And as we look to many of the underlying conditions that influence a late cycle, whether it's credit growth, profit margins, interest rates, inflation, we see a lot of mixed signals to support that we're nearing what we would classically call the end of the late cycle, and very much feels that we're still, quite deep in the middle of that cycle. So with that, kind of pivot a little bit to just talk a little bit of our outlook from, our asset class views. Something we go through every quarter. No changes here relative to prior quarter. So it'd be helpful to kind of walk through, a couple of the items here that we think are more of importance. The first being just what's the outlook for developed market equities. We've had some pretty profound positives for U.S. and in some cases for EFI markets for the year to date. When you look at numbers of the last 12 months, not as much change considering the sell-off in December. But kind of encouraging folks, take a look at what's your equity exposure relative to target, thinking about is there an opportunity to possibly rebalance and get more in line with kind of longer-term risk postures. And I think the other contributing thing that we think about is when we think about a late cycle market environment. I mentioned that very much you can have positive outcomes, but in some ways the negative outcomes are more likely than they would be in any other market environment. And so one of the things they're encouraging is just be very cognizant of your risk profile and very cognizant of your overall equity posture. So thinking about that, especially relative to your views, to our views, thinking about target weights of global equities. And so, when we think about our global equity target, index here in the bottom right of, US, EFI, and emerging, as we look at, where we'd like to take tracking risk or where we'd like to take overweights, preference still very much into the emerging markets. We think there's a lot of factors to support EM remaining an overweight, and especially if we see positive trends in trade cycles and trade markets, we really should see a big bump in emerging markets, hopefully with positive outcomes of U.S. China. When we think about kind of the sizing of it, I think one of the things we'd encourage is essentially using non-U.S. markets or EFI markets as a way to fund your overweights to the emerging markets. And when we think about U.S. Small underweights, but for folks where maybe not taking bigger over-underweights in the international space, having a kind of target weight to the U.S. can still be, very much an appropriate posture when we look at, some of the late cycle developments that we mentioned. Last on the views is just thinking about credit markets. Credit markets have done fairly well this last year. As we think about kind of encouraging folks to really take a close eye at their return-seeking credit exposure. And so, with that, double B space, single B space in the high yield market, encouraging right-sizing that exposure, encouraging some amount of underweights, and using that either to redeploy to some degree into dry powder within the portfolio to be used later on, or in some cases use it to allocate to risk assets somewhere else in the portfolio, whether that be private markets funding or other areas. Albeit yields have come down quite considerably from this time last year and beginning of the year, but still have some concerns about what's the risk return outlook for a high yield, and are you being compensated for the risk that you're taking on in that space? So, as we get closer to the end of the year, we want to talk a little bit about what are some things that we're thinking about for 2020 to kind of just open the book a little bit. A lot of these things are in draft form, more kind of open-ended questions or questions that we're assessing for ourselves and challenging ourselves on. And some of the things that we're thinking about is just with our current market themes, are we likely to see any changes? And I think the simple answer is no. But also we're thinking about, there's clearly dynamics have changed in terms of how interest rates are moving, how the power of central banks and their ability to even tighten when, in some cases, we've had many years of positive growth. So do we need to rethink about what long-term targets for interest rates for inflation embedded in the global economy? I think kind of more poignant is thinking about, what's the right valuation for interest rate sensitive assets? Thinking about, treasury markets today. As we look to our capital market assumption process, we run some of the models in draft form today. We're seeing that, long duration treasuries especially are significantly lower from where they were last year when we published our assumptions. And in some cases are moving closer to, 0% expected returns. So when we think about how we use interest rates, how we use kind of safe haven fixed income for diversification, it's becoming much more complicated in an ultra low interest rate environment. And then also when we think about just, longer term in the public market space, what are some of the tail risks out there that would surprise markets? I think U.S.-China trade policy is definitely a tail risk. Would that necessarily be a surprising tail risk? And so I think one of the things that, we were thinking about, what would be the greatest shock to the market discounting function in terms of risk premiums and discount rates? And I think one of the things that we've kind of zeroed in on is the prospect of inflation. If we saw inflation, that would be a very big surprise to the markets. We're not necessarily of the view that we'd see an uptick in inflation, but you kind of have to consider all possibilities in many ways, and this would be one of the larger surprises that one would see. And the last piece that kind of would want to leave everyone with is when we think about our capital market assumptions process, And I think most are familiar with, how we publish our numbers and how we develop our numbers. And just think about, what our numbers have been for the last couple of years. Really want to prepare folks that likely be, materially lower coming into 2020. Is when you have strong equity markets, you have, interest rates falling by considerable fashion, you have lower inflation, you have lower cash rates. Those are all factors and dynamics that lead to, lower return assumptions. And I think in some cases for, portfolios or investors that are shooting for a long-term target of 7.5%, that maybe don't have, a large amount of private equity or private equity in the ground or looking to build those allocations, 7.5% return target may be a more challenging outcome in the long term. So there's a resetting and recommunicating of expectations that you'll likely see from here on out for the rest of the year and also the beginning of 2020. And just, just to that point, we showed this slide internally and kind of jokingly said this is a very easy slide to create. We essentially just copied and pasted lower all the way across the board, but frankly, it's apt. We don't really see an asset class amongst the 60+ asset classes that we model for where returns are going to be higher than they were in 2019. So it's a bit of a sobering message, but one that, we want to be realistic of, how, the building blocks of valuation, interest rates, real growth flow into our asset class models. And a lot of those underlying factors are likely going to be headwinds to higher returns. So with that, maybe take a moment and see if there's any questions before we wrap up. Maybe one quick piece, just jumping back to some of the trade policy discussion. Thinking about tariffs and rates. There's a slide that you showed, Jen, that kind of outlined the U.S. compared to other areas in the globe in terms of what their tariffs are. Any thoughts on how that impacts global economic growth over the long term? Is it a big impact, or are tariffs more of just kind of a soft, subtle tax on maybe economic growth rates?
Yeah, I think so. We talked about that shift from the U.S. being to the far left versus far right of that chart. And I think that clearly when you think about higher tariff rates, that is a less business-friendly environment and less trade-friendly environment from a global trade standpoint. So I think that can definitely have some impacts on the interaction between these large regions. But we've seen a few examples already of some manufacturing firms trying to open back in the U.S., so that could potentially have a positive domestic effect as well.
Great. And then, one kind of more logistical question that's come up. When will we be publishing our capital market assumptions? And per usual to our process, we'll be releasing those in the middle of December, and we'll be publishing them, sending out to all their clients to review over the December break, to really help people, kickstart into January to review their asset allocation targets and objectives. So with that, we have one last question coming in. So maybe tackle that briefly. And I think one of the things that, thinking about in terms of capital market assumptions as they come out in December is, as we think about what's the level of changes that we are likely to see in terms of our assumptions. We showed, many of the asset classes being lower, which is, directionally accurate, we think. But I think one of the things that thinking about is what's the scale that we're likely to see. And I think in some cases, some asset classes may be more muted, 25 basis points. but others in the Treasury camp, 50 to 75 basis points lower at a minimum could be things that likely to see. And I think one of the things think about is what are some areas that will likely favor as some of these asset classes adjust. And I think you'll see still a bit of a bias towards incrementally raising private market exposures. We think those things can be areas that can provide longer term returns that benefit a portfolio, but also in many ways the pure form of alpha that hopefully they're identifying quality companies, quality balance sheets, making incremental improvements to the business profile of a company that hopefully can withstand a little bit more of the economic vol that we might see coming. So with that, I think we'll end there. Thank you everyone for joining us. And just as a reminder, we post these slides and a copy of this webinar on our website. So probably posted end of the day today. So feel free to take a look. I'm going to pull that down and get a copy of the slides and rewatch if you like. So thank you all.